So in the app, there's a loan feature, and I've drawn up this example. And that is you can borrow $1,000 fiat over a 6-month term. So you pay back over 6 months at an interest rate of 1% APR, which is based on the cash option. You can pay back in Celsius as well, but this is the cash option, and it is the lowest interest that you can select, which means that as a result, you have to put in about 0.1 BTC as collateral. Now, you can put other cryptocurrencies as collateral as well, but I've just used BTC as an example. And given today's price, which is about 40,000 for one BTC, this means a collateral in this example of approximately $4,000. So what this is saying is you have to put down $4,000 in value in collateral in order to borrow $1,000 over a 6-month term, paying at a 1% APR. And this 1% APR is an annual rate. So what this means is $10 over 12 months. And because this is a 6-month term, essentially the interest is $5 over the 6th month for the interest, which is really low and very favorable. Only $5 that you have to pay back, which is essentially free interest, which basically means very low cost of borrowing and very favorable. But let's look at the ratio. This is 1-4, which means every $1 you borrow, you have to put down $4 in collateral. And that is very positive on Celsius's side. They're definitely doing it right and not over leveraging themselves. If we take account of, for instance, mortgages, banks issuing mortgages, essentially you're 10-1 on mortgages. So that means if you wanted to borrow 500,000, you have to put in 50,000. Sorry, 500,000, 50,000. So that means that you're over leveraged, or banks are over leveraging. So you can see the risk difference between Celsius and a traditional bank. And that in part explains why banks also can't pay you as favorable interest rates as Celsius does, is because they're already over leveraged. Their business model is based on being over leveraged. If everyone wanted to withdraw at the same time, then banks cannot fulfill all those requests because they simply don't have in deposits as all of that in one go. They have to. They're in different financial products. So we can see that the ratio 1-4 is very good from Celsius's perspective. It means that in order for the amount borrowed to be equalized in the collateral as it stands would have to fall 75% before it reaches the value of $1,000. So very low risk from Celsius's perspective. So the issue is not, the default per se and the amount owed, because it can fall below this 4,000 a lot before it hits the 1,000 that is owed. Now, the thing is this $4,000 has to be maintained, and obviously the price of BTC has been going up, so we haven't had much what we call margin calls, which is very important. So essentially, margin calls means that when your collateral falls below the agreed value, you're going to have to add more Bitcoin in order to maintain that 4,000.